and welcome back to another episode of The Wealth Equation. I'm your host, Maurice L. Wilson, engineer turned financial advisor. And today I want to talk about what you do when the market goes down. One of the things that I talked about early on in The Wealth Equation was the market going down. It's one of the things we tend to forget when we've had these bull markets. We've had a pretty good run the last few years, and we're entering a year now with a lot of volatility due to geopolitical conflicts, inflation, rising energy prices. The AI trade is in question. And so the market has been volatile to negative in the first few months of the year. Investors are definitely getting scared. And it's time to talk about what do you do when these markets go down like this? Because how you handle these downturns is critical to building wealth. So one of the first things you want to understand about markets that go down is, one, stop trying to figure out why markets are going down. The stock market, for some reason, induces people to have all the answers in a way that we don't do other aspects of life. For example, we don't really ask, why did it rain today? We know it's going to rain someday, right? And so we don't really question, well, why is it raining today versus yesterday? Why is it windy today versus not windy on another day? With the market, the going down of the market is a natural occurrence in the stock market. But for some reason, we want to know why it goes down. Now, if I had to take a guess as to what that reason was or is, I would say that we want to know which days not to be in the market when it goes down so we can maximize our wealth. And this is something that people will have to learn time and time again. I had to learn it as well. You can't predict when the market's going to go down. So if you can't predict when it's going to go down, yeah, you wish you were out when it went down. But here's the thing, it's going to go down. And when it is down, you will be tempted to try to figure out why it's going down. The media cycle is going to give you a bunch of reasons, but think about it. If those reasons were 100% true, then the day before it went down, you would get a report saying, hey, the market's going to go down tomorrow for the reasons we're telling you it went down today. Does that make any sense? So if we know it goes down because there's a war going, if we know it goes down because energy prices go up, then when energy prices go up, we can say, hey, investor, John Q investor, sell all of your investments until oil prices start going back down, because the market's going to go down as long as oil prices are going up. That correlation is not permanent and it's fleeting at best. First thing you want to know when markets are going down is you don't know why they're going down, nor should you care. That is not the assignment. That's the assignment if you are a talking head on the major financial networks, one of these financial influencers, or you make your money predicting day-to-day directions in the market. But you make your money by buying good investments on sale. And that brings me to point number two. The goal of the stock market, the goal of investing in the market, the goal of doing anything in a market is to buy low and sell high. Buy your house at a lower price, sell it at a higher price. Buy your stock at a lower price, sell it at a higher price. Buy a business at a lower price, sell it at a higher price. And the only way you can really get these lower prices other than out of the gate is to have opportunities to buy them lower later in the ownership cycle. Well, when markets go down like they've done over the last few weeks, this is an opportunity to potentially buy some of your favorite companies and pieces or parts of the market on a discount. As long as you're not preoccupied with trying to figure out, hey, why is the market going down? Who cares? Other than bragging rights and something very fleeting, making perfect market calls is mainly for bragging rights, and then knowing why it went down, bragging rights. So what you want to focus on is, what happens when it goes down? What am I going to do next? When do I take advantage of the lower prices? And that's what you want to focus on. So it's going down. You don't care. You're focusing on getting a good price. And there are different price points that will give you potentially higher returns on market recoveries. Typically, you can just do simple math. If you buy something that's down 25% and it recovers back to its original price, that's a 33% gain. That's pretty good, right? If you buy something that's fallen 50% and it recovers, that's 100% gain. If you buy something that has fallen 75% and it recovers, that's a 400% gain. So you want to look for things that are on sale at particular key levels. Now, none of these are guaranteed. I can't tell you which stocks or sectors are going to fall by that amount, but you're looking for steep discounts and sell-offs. Now, when it goes down, you don't care why it goes down. You're focused on getting a certain price when it went down. And then the third thing you want to know is, well, Maurice, what should I be buying? I think that a lot of the market, I feel like, is guesswork. And what I mean is there's something called the Mag 7, which is the Magnificent Seven. It's Tesla, Amazon, Apple, Google, Meta, and Netflix, if I'm not mistaken. There are these group of 7 stocks that have been generating great returns the last 4, 5, 6, 7 years. Now, if you told a professional investor, pick the one stock that's going to lead the pack over the next 7 years, over the last 7 years, they couldn't tell you. That's the guesswork. There are funds that would just buy all 7, right? Because they were like, okay, we're not going to try to figure out which one of these stocks is going to be on top. We're just going to group them together in a package and deliver them to people so they can buy. And for a lot of people, that was a winning strategy. This is what indexing is based on. We're just going to create a fund that owns 500 of the biggest stocks in the country, S&P 500, and it's an S&P 500 index fund. It's a Dow Jones index fund. It's a NASDAQ index fund. And when the market goes down, that may be a way to give yourself a chance to benefit. Instead of trying to pick the one stock, you want to look at baskets of stocks. The leaders will eventually present themselves, but maybe you want to look at a basket of stocks to invest in on these recoveries. So let's recap. Market's going to go down like it is right now. Maybe it's the Iranian war. Maybe it's energy prices going up. Maybe it's inflation. Maybe it's the low jobs number. Who cares, right? You do not care about that. What you care about is what are the different price points I want to buy into this market and why? And the why is, hey, if I buy it this low, it's going to go this high. If I buy it really low, it's going to go even higher. And the third thing you want to focus on is what do I want to buy? What areas of the market do I want to be in? And I wouldn't overly concern myself with picking a particular winner from a particular group. Looking at the group overall to give yourself a better chance of winning when the market does recover. Markets are going down right now. They may go down all year. We've had a few years up, 2023, 2024, 2025 was up, but it was kind of impacted by tariffs. Maybe we're overdue for a bad year in the markets. Do not fret. You want to buy low and sell high. Bad markets deliver lower prices that will go higher in the future. So you don't care why it's going down. You want to find your price points to get in, and you want to find the group of stocks that you want to be a part of. If you do that, you will be working towards your wealth equation. My name is Maurice L. Wilson, engineer turned advisor. You can find out more about me at www.wilsonwealth.com. You can also visit us on YouTube at the Wealth Equation Podcast with Maurice L. Wilson. Until next time, keep building.